Hello, I'm Jamie Cowper, President and founder of Unity Financial Advisors. You must be joining me this evening because you're interested in finding out more information about annuities. Well, you've come to the right place. I've got 19 years experience with annuities, and at Unity Financial Advisors, we take a holistic planning style. So we incorporate insurance solutions and investment strategies for our clients, and sometimes that involves annuities. So today I'm going to talk about some of the basics, and if you'll bear with me for a minute here, I'm going to share my screen for my presentation. All right, so here we are, Annuity 101. As I mentioned, Unity Financial Advisors, we have insurance solutions and investment solutions. And on the insurance side, we are independent, meaning we can represent any insurance company out there, whatever the best fit for the need for our client. And then on the investment side, we are affiliated with an RIA, and we have chosen an investment team, Advisory Alpha, that does the professional trading and the research, the professional money management for our clients that have money in the market with us. So I'm going to spend about 20 minutes today talking specifically about annuities. I'm not going to be making any specific recommendations, just some of the basics, and feel free to jot down questions that you have, and would love to answer those one-on-one. We're going to talk about the different types of annuities. We're going to talk about, is it a good fit for you, and which type might be a good fit for you. So let's get into it here. We've got two areas that annuities can be broken down into are considered deferred or immediate. And most folks will go for the deferred route versus immediate, which means that you're going to be turning that right away into an income stream. With both deferred and immediate, you can have fixed or variable. And like the title implies, fixed meaning having some level of guaranteed or maybe a fixed rate, where variable, there can be some fluctuation. With a deferred annuity, often people put a lump sum or even some periodic payments, but the premise is that you'd plan to leave that and let it grow for some time. You can see here the cash value growth, and then at some point in the future, take some money out, or you could then change it into an immediate annuity at that time, as this example is showing, and trigger an income payment for life. As I mentioned, generally the deferred annuities are designed to provide a future payout, or like I was saying, you might decide to completely cash the account out or make some withdrawals in the future, but planning to let that grow for some period of time, versus immediate being right away having an income payment. And actually immediate annuities can be considered, if you've heard that term, annuitization, that's essentially what an immediate annuity is. And I'll talk more about that a little later. Deferred annuities, like I mentioned, can be a lump sum, or they can be adding money over time, periodic contributions. Immediate annuities would typically be a lump sum, or as I mentioned, you could defer an annuity for a while and then turn it into an immediate annuity. But when you do that, you don't have as much flexibility if you've triggered the immediate annuity as you do in deferral. Once that payment is started, it cannot be stopped, and it's a contract. You're aware of, the terms at that point, but it would pay out according to those terms, compared to deferred annuities, which you can surrender, you can take money out. There may be penalties early on, depending on the annuity, but you typically would have some access, and then you either might do something differently in the future, or you might cash your money out. So there's a little more flexibility with that. So let's get a little more detail on deferred annuities. There are different types of deferred annuities. You can have fixed indexed, or variable. It's kind of, again, in the title, the fixed and fixed index typically provide some sort of fixed rate, or there's principal protection with fixed and fixed index. With the fixed annuity in particular, it would typically have a rate that you would start out at, and most likely a minimum guarantee, Fixed annuities are insurance products with insurance companies, so they're regulated by the states, just like fixed index annuities, which are also insurance products regulated by the state. With a fixed indexed annuity, the growth is a little different. It does have the principal protection like the fixed annuity, so it has a guaranteed death benefit, and whatever the account value is would be the death benefit for the fixed or fixed indexed annuity. But the growth would be tied to how an underlying index performs over a period of time. So think of it like if you opened it today, maybe a year from now, they're going to track an index, maybe the S&P 500, for example. That's a familiar index. They're going to take a look at where is the index today, where is it a year from now. If it's higher, then you have potential to earn some of that growth, typically not all of it. And then if it's lower from period to period, you get a zero, you don't credit anything, but you don't go backwards because of that principal protection. So every period's a new period. The index needs to go up from where it left off the last period to earn. So with the fixed indexed annuities, they may have a little higher growth potential over a long period of time compared to the fixed, again, depending on the rate. However, you don't know exactly what it's going to earn. So that could be something that's worth considering. And then we've got variable annuities. Just like the title implies, it's going to fluctuate. There's no principal protection with the variable annuity. The investment results are from the sub accounts within the insurance company. It's kind of similar to mutual funds, but it's going to fluctuate based on the value of those underlying sub accounts. As far as guarantees, variable annuities, again, do not provide principal protection. They do have what's called a mortality and expense charge. You're paying for a guaranteed death benefit. And what that means is if a client passes away, their beneficiary would be guaranteed at least what they put in. So if the market happened to be down when they passed away, their beneficiary gets at least the amount they put in. Of course, if it's higher, then they would get that amount. So there are some various fees with variable annuities, but of course, then there's the higher growth potential. So if you're looking for higher growth potential, but you want that minimum guaranteed death benefit, or sometimes there's income riders you can add, and that might be something worth considering as well. You've got this one's regulated by both the SEC, the Security and Exchange Commission, as well as the states, because it's an insurance product and a security. All right, so let's look at the difference between variable annuities and mutual funds now. In this example, we're going to assume that it's not an IRA or not IRA money, that this is non-qualified investment. For example, pretend that you put $100,000 into a variable annuity that you had in the bank, or similarly, you put $100,000 in a mutual fund. So the taxation is a little different. There's some tax benefits with variable annuities where the growth inside the account is tax deferred until you take it out, and then you pay ordinary income tax on that growth. With a mutual fund, you're paying some level of tax every year, depending on the turnover in the account. And then when you go to sell or make withdrawals, you may have capital gains tax. So it's not ordinary income tax, but a little different there. And then with a variable annuity, again, the guarantees would be typically if you've added a rider that you're paying for, they can have an income guarantee. And then, of course, inherently, like I mentioned, with a variable annuity, there is that mortality and expense charge, which can range from 0.5% to 1.5%, but that provides that guaranteed minimum death benefit, again, the amount that you put in. And then with mutual funds, as you may know, it's an investment, so there's no guarantees to principal or any other sorts of guarantees there. The variable annuities are regulated, like I mentioned, by both the state and the SEC, where mutual funds are regulated by the SEC. All right, immediate annuities, again, think about that term, annuitization. That would be paying out an income stream or guaranteed income stream for life. And when you choose this option, like I mentioned, it's either putting a lump sum in and saying to the insurance company, how much are you going to give me for the rest of my life? Or if you've deferred an annuity, it could be changed into an immediate annuity based on that value at that time. But the annuity payments really come from three sources: return of principal, investment income, and that survivorship pool, which means people who die early subsidize those who live longer. And that's one of the ways the insurance companies can give you an amount and guarantee it for life, because of those life expectancies and the amount of people that are in that pool. So here's a good example to help explain that. When you annuitize or trigger a guaranteed income benefit, there are different options. This is showing a chart based on a male, female, or a joint couple at the age of 70, and we're assuming that they put 100,000 into an immediate annuity, and this is giving you an example of what the insurance company might give them. So when we think about life expectancy, women typically live longer than men, right? So if you think about the risk to the insurance company, it's a higher risk that they'd have to pay that out longer. So if you look at the first column, this is what we consider single life only. You can see that it states no death benefit. What that means is the insurance company is going to give you the highest amount they'll guarantee you for the rest of your life in these examples. And then when you pass away, there's nothing left. So if you live past life expectancy, it was definitely a good decision. If something happened in the early years, the insurance company keeps the rest of that. So back to my point about women, you can see that for a male, they're going to give a male a higher payout figure because of the life expectancy. They have actuarial tables to determine the payout factors. And so for a male, it would be a little higher, for a female, a little less. And then, as you can also imagine, because it's two lives now, if you want a joint payout, you and your spouse, you want to make sure that when one of you passes, the other continues the income. They're going to start it out at a lower amount, and that guarantee is what it is. So you have options. Then there's also options called period certain, life with period certain, and that's this last column here. So if you don't like the idea that if something happened to you, too soon after triggering the benefit, no money goes to anyone, then you might do a period certain. So they're not going to give you quite as much, but with a period certain, in this example, 15 years, let's take the male, they're going to pay the male $8,040 for the rest of his life. If he lives to 120, they're going to pay that $8,040 a year. However, if he passed away after the 10th year, they would continue those $8,040 payments to a named beneficiary for 5 more years. That's what period certain is. They have sometimes 10 years, 15 years, and those are things that you would know when you enter into the immediate income. So can I just do this myself? Well, hopefully I'm demonstrating that there's a lot more to annuities than you may know. And so I would say it makes sense to either work with us or someone like us that has a lot of knowledge in this area. We're going to help you, we're going to ask you a lot of questions to help determine, first of all, what direction to go in, which type of annuity may make sense for you. And then we're going to help bring different solutions to you. So typically we'll bring 2 or 3 different options to our clients after we've narrowed it down. So trying to do that on your own would be very cumbersome and difficult if you don't know what you're looking for. So what can annuities do? Well, really, they help to mitigate one of the biggest risk factors in retirement: longevity, outliving your money. Based on current data, 1 in 3 women, 1 in 5 currently age 65 will live until age 90 or older. So how do you know your money can last? Well, you want to build in some income guarantees, and that's what annuities can do. The other thing to keep in mind is how healthy you are. So there's been some statistics that if you avoid these 5 adverse factors of smoking, obesity, hypertension, diabetes, sedentary lifestyle, that there's over a 50% chance that you could live into your 90s. And what happens if you do live into your 90s? How do you know your money's going to last? So that's where it might be worth considering an annuity. So again, is this right for you? Is this right for everyone? Well, I would say no, it's not right for everyone. And we don't ever believe you should put all your eggs in one basket. Our premise for planning would be to have different buckets with different objectives, and it may make sense to include annuities as one of those buckets. We want to match your time horizon, look at your goals, want to help you to have buckets for inflation or healthcare costs in the future. And one of the other major parts of our strategy are helping our clients to have guarantees for income to meet their basic living expenses. And once those are met, maybe you take more risk for some other buckets and have your fund money or some inflation buckets. But again, providing some guaranteed income. And you probably have some of that already. So here's an example of how we help our clients and what you would have as a guaranteed income bucket. You can see that Social Security in this example makes up 50% of the income goal that the client needs. And I actually have additional training in this area. We help our clients to analyze their Social Security, and I hold the certificate of the National Social Security Advisor. So with that analysis, we can help educate you to make a decision to try to maximize the most from the government with this one bucket for income. So that's a guaranteed source. Then if you have a pension, there's another guaranteed source for income. One thing I want to mention about pensions, basically a pension is having an annuity, an immediate annuity. And sometimes people don't realize that, but I've never heard anyone say they don't like their pension because it does provide that guaranteed income. So for folks that don't have pensions, providing your own personal pension is important. And then maybe you add in some annuity income to fill some of those gaps to really increase that income stability ratio. You can see in this example, it's at 80%, meaning this person knows that 80% is coming from guaranteed sources, and then they're not as concerned with only 20% coming from money that can fluctuate. So that's what we help our clients to do. So some suggestions, definitely buy from a financially strong company. We recommend the top insurance companies. Again, I mentioned we're independent, so we can look at the best solutions for our clients. We typically only recommend A-rated companies and above. Insurance companies are very tightly regulated. They are looked at quarterly, their financials, and rated quarterly. You can check with your state insurance regulator regarding complaints about companies. And then definitely would recommend working with someone who puts your interest first. We are fiduciaries. We're required to do what's in your best interest. We take that very seriously. We also take a look at your total plan and how does it all fit together compared to some cases where you might just talk to someone about one area, or maybe they only offer one area. So we're going to help you to determine what makes sense in your overall plan and then help you along the way to monitor that and make changes. Also, I mentioned different buckets with different objectives. That's our overall strategy. So again, we're not going to recommend that all of your money go into an annuity. It may make sense for a portion. It may not make sense. But that being said, we'll help you to take a look at how much you have in savings and other buckets to go to for different objectives in the future. So I get the question a lot of times, how safe is an annuity, or what about these insurance companies? So the insurance companies really have very few impairments. And again, we typically recommend the top rated companies, so we're not overly concerned about that. But of those that do have liquidity issues, they typically would have enough to pay benefits. If they don't, one thing you've probably heard, maybe your mortgage company was bought out by another insurance company, and now they're servicing your account instead of the company you started with, but it's still the same mortgage. So it works the same way with annuities. If there's a block of business, another healthy insurance company may come in and buy that block of business. Nothing changes for your contract. So that's kind of the next line. If none of those approaches work and they go into conservation, then the state guarantee fund steps in. The state guarantee fund, all insurance companies are required to pay into that dollar for dollar up to a certain amount per state. It's not the state that you live in, it's the state that the insurance company is domiciled in, and they're required to have that set aside to provide those benefits. So the middle section are most of the insurance companies we work with have that 300,000 limit. And what that means is if you're married, for example, and both of you have 300,000 with the same insurance company, that state guarantee would apply 300,000 for each of you. So again, we're not overly concerned about this, as again, we work with the top companies, but it's nice to know that there are some additional guarantees there. All right, so other sources of information, a good website to check out is annuity.org. They can help answer some additional questions you have. Some statistics. You can check out additional information about the different types of annuities as well. So hopefully that was some good information. I know it was a little quick, and there's definitely more to speak about annuities. They're not for everyone. They may be a good fit for you for a portion of your assets. We can help you with that, and we definitely would love the opportunity to sit down with you at a no cost, no obligation meeting, give you a second review, or even if you aren't working with someone, but maybe you are not sure how you're going to take your money out, or maybe you're just comfortable and you think, hey, I'm okay, but it comes down to, I guess, what you don't know can hurt you. So any information is always good. Like I mentioned, we're fiduciaries, so we're going to take a look at what you currently have, and if there's a way that we can help improve that situation, we would make a recommendation. It doesn't mean we're going to require you to change everything, or even suggest that you change everything. If you've got some good things in place, we'll tell you that. So would love the opportunity to sit down with you. If you do come in, we will offer a free copy of my Amazon best-selling book, Mama's Secret Recipe for Retirement Success: The Truth About Risk, the Stock Market, Fees, and Annuities. This book further highlights the misconceptions that folks have regarding fixed indexed annuities. I had the opportunity to be featured along with about 20 other top advisors from across the country. I wrote a chapter. In my chapter, I talk about the misconception that you don't have access to your money. So that's one of the questions that people may have. They say, well, I heard I can't touch my money if I put money in annuities, and that's not true. You have access to some of it, and it depends. Again, there are different types, as I talked about, especially in the past 20 years. There have been additional riders that you can add for income guarantees. That's a little different than annuitization. So you'll see in my chapter, I talk about the difference there between annuitization and triggering an income benefit, for example. So there's a lot more to be said about annuities that you may not know. Definitely recommend checking that out. You can download a free copy of my chapter on our website, www.unityfinancialadvisors.net. Or again, like I said, I'm happy to give you a copy if you come in, and would love to answer your questions. Also, just to note, in the book, there's a lot of great information. It's not an easy read. It wouldn't be in one sitting, but you can pick chapters out. But in my chapter, I do walk through a case study of how we help clients to put together the overall strategy, including Social Security and such. So you may find that interesting. So, all right. Well, I want to thank you for joining me this evening. Like I mentioned, would love the opportunity to sit down with you, answer your questions, get to know you a little better. What sets us apart is not only our strategy, but the relationships that we have with our clients. We really enjoy what we do, and our goal is to help clients put together a comprehensive plan to achieve peace of mind in retirement that may or may not involve annuities, but would love the opportunity to get to know you a little better. So feel free to give us a call, 248-885-8176, and have a good evening. Thank you.